Hedge fund titans, George Soros and Ray Dalio, the men who bet on the world.
One of the greatest elements of being a teacher is not just what happens inside the classroom, but all the opportunities that are outside the classroom as well.
London, early 1990s. In a glass-walled office overlooking the Thames, a man in a dark suit is staring at charts of a single number. The exchange rate between the British pound and the German mark. To most people, an exchange rate is background weather. It's what you check before a trip, the silent translator between one country's prices and another's. To governments, it can become something else entirely. A promise, a symbol, a public commitment that says, we are stable, we belong, we will hold the line. Britain has made that kind of promise. It has pledged to keep the pound inside a narrow band as part of the European Exchange Rate Mechanism, the ERM. In theory, it is a bridge to a more integrated Europe. In practice, it means your domestic economy has to behave as if it lives inside someone else's constraints, and if it doesn't, the market will punish you until it does. The man at the window thinks the promise cannot be kept. He believes the pound is overvalued, that Britain's economy is too weak for the interest rates the ERM demands, and that political will breaks faster than central bank reserves can be replenished. He is thinking like a central banker who has decided the peg is a bad policy. Except he's not trying to defend it. He's trying to profit from the moment it fails. He runs a hedge fund, and his name is George Soros. And he is about to make a trade that becomes financial folklore, not because it's mysterious, but because it shows, in pure form, how money, policy, and belief collide. Soros' story doesn't begin in London or New York. It begins in Budapest, in a Jewish family that survives the Nazi occupation through forged papers and careful hiding. As a teenager, he sees how quickly a society's rules can dissolve, and how dangerous it is to treat any system as permanent just because people agree to call it permanent. After the war, he emigrates to England and studies at the London School of Economics, where he falls under the influence of the philosopher Karl Popper. Popper's core idea that knowledge is fallible and open societies need mechanisms to correct their own errors becomes part of Soros' mental wiring. He doesn't treat markets as calm calculators of truth. He treats them as feedback systems where belief shapes behavior and behavior reshapes the world that belief is supposed to describe. He works in finance, moves through the industry, and in the 1970s sets up what becomes the Quantum Fund. Strip away the mystique and the pitch is blunt. Give me your money, and I will move it around the world, buying and shorting currencies, rates, stocks, and commodities based on my reading of politics, policy, and crowd psychology. He's not hunting any anomalies. He's hunting unstable regimes, the places where policy is held together by reputation and willpower, rather than by arithmetic. Betting against a currency sounds like a casino line. In reality, it's plumbing, and the plumbing matters because it determines whether you can stay alive long enough to be right. At its simplest, you borrow pounds, sell them for marks or dollars, and hold a foreign currency. If the pound falls, you buy pounds back more cheaply, repay the loan, and keep the difference. But large macro positions are often expressed through forwards, swaps, and options because those instruments let you take big exposures with defined settlement mechanisms. A forward contract is an agreement made today to exchange currencies at a set rate on a future date. If you believe the pound is too strong, you can agree to sell it forwards at today's price. If the pound falls by settlement, the position gains. Options add asymmetry. You pay a premium for the right to sell at a certain rate. If the move becomes violent, the payoff can spike. If you're wrong, the loss is capped at the premium. In practice, big macro funds spread exposure across multiple instruments and obsess over the unglamorous detail: funding costs, collateral, margin calls, and timing. Because the hardest truth in macro trading is this: you can be correct on fundamentals and still lose money for a long time if you are early. So macro traders don't only ask, "Am I right?" They ask, "Can I stay solvent if I am early?" Soros has a concept he calls reflexivity. The idea is simple enough to be unsettling. Markets are not cameras, they are participants. If investors believe a currency peg is credible, capital stays, borrowing costs remain manageable, and the peg survives. Belief becomes self-reinforcing. But if investors doubt the peg, they sell. The central bank must defend the currency by spending reserves or raising rates. Those defenses are costly. They can weaken the economy, stress banks, and erode political support. The act of doubting can help create the failure. It's a bank-run logic applied to a nation's exchange rate regime. If enough people run, the institution fails, not necessarily because it was always doomed, but because the resources required to stop the run exceeded what the institutions can or will deploy. This is what Soros hunts: moments where policy, fundamentals, and expectations are out of alignment, and where the cost of forcing them back into alignment is politically intolerable. Now we return to Britain in 1992. The ERM is meant to stabilize currencies across Europe, a preparatory step toward deeper monetary integration. Britain's membership is about stability, but also about credibility. It signals seriousness, and it is supposed to anchor inflation expectations. But Europe is living through a shock: German reunification. The fiscal demands are enormous. Inflation pressures rise. The Bundesbank, committed to price stability, keeps interest rates relatively high. Britain is in a different place. Growth is weak, unemployment is high, the housing market is strained, and higher interest rates, the main tool used to defend the currency, hit households directly through mortgage payments. In a world of variable rate mortgages, a rate hike shows up in kitchens. Here is the trap. To keep the pound inside its band, Britain needs holding pounds to be attractive relative to holding marks. If Germany offers high rates and Britain can't match them without crushing its economy, capital flows towards marks unless investors are deeply confident the pound will hold. If investors start to believe devaluation is likely, even high rates may not be enough. The expected loss from a devaluation overwhelms the yield. So, pressure builds. Traders sell pounds and buy marks. The Bank of England fights back by buying pounds with reserves and signaling higher rates. But reserves are finite, and interest rates have a ceiling set not by theory but by politics and pain. Soros looks at this and sees brittleness. He doesn't need the exact day of failure. He needs to believe the system is structurally misaligned and will eventually be forced to resolve. He borrows pounds at scale, sells them, and builds a position that pays if Britain is forced to devalue or exit. He's not alone, and that matters. Speculative attacks are coordination events. Once enough capital leans the same way, the pressure becomes part of the proof that the system is under strain. On 16th September 1992, the pressure turns into crisis. The government announces emergency rate hikes, trying to convince markets it will do whatever it takes. Markets don't believe it, because whatever it takes has a limit when the price is domestic economic damage. By the end of the day, Britain exits the ERM. The pound falls. Soros' fund reportedly makes about $1 billion. The nickname arrives instantly: the man who broke the Bank of England. That nickname is memorable, but the real lesson is subtler. Soros didn't break the Bank of England like someone breaks a chair. He exploited a contradiction between a promise and a constraint. A peg is not just a statement. It is a commitment to use your balance sheet and your interest rates to defend a number. If defending that number requires pain the country cannot tolerate, the peg becomes a hostage situation and markets test the hostage taker. Eventually, either the economy breaks or the peg breaks. Britain chose to break the peg. And here's the part that surprises people who only remember the drama. Many argue the exit was a release. Freed from ERM constraints, Britain regained control of monetary policy. Rates could fall, the economy could recover. The humiliating day became, in hindsight, a reset that better matched policy to domestic conditions. That does not mean speculative attacks are good. It means markets can force an unsustainable system to admit its limits. The market can be cruel, but it can also be corrective. Soros' trade became iconic because it showed a kind of power. Capital pressuring policy when policy rests on credibility alone. In the years that follow, Soros grows richer and far more visible. He uses his wealth to fund foundations and NGOs promoting education, human rights, and open societies, especially across the former Eastern Bloc. To admirers, he is a rare financier who treats civic resilience as something worth investing in. To enemies and conspiracy theorists, he became a convenient villain, a foreign speculator to blame for forces people would rather not confront directly. He becomes a lightning rod partly because he speaks openly about the link between markets and politics. But in markets, his method remains consistent. Read the world, find the contradiction, size the bet, and accept that being wrong is expensive. Now, if Soros represents macro trading as philosophy and opportunism, the next figure represents macro trading as system design. Westport, Connecticut. A campus set among trees and ponds, designed to feel more like a research institute than a trading floor. In meeting rooms, framed sentences hang on the walls like doctrine. Pain plus reflection equals progress. Radical truth. Radical transparency. This is Bridgewater Associates. Its founder, Ray Dalio, is trying to do something that sounds almost impossible. He wants to understand how the global economy works as a system, translate that understanding into explicit principles, and then turn those principles into models that can guide, and sometimes automate, investing decisions. Soros is comfortable with messy narratives and psychology. Dalio wants an engine. Dalio grows up in a middle-class, Long Island family. As a teenager, he caddies at a golf club and overhears stock tips from wealthy players. He buys a few shares, they rise, and the feeling is immediate. Markets are a game with rules you can learn. And if you learn them well, the game can change your life. He studies finance, trades commodity futures, and in the mid-1970s starts Bridgewater out of his apartment. He has early success, then a spectacular failure that becomes his turning point. In 1982, convinced the world is heading into a depression after a debt crisis, he positions for catastrophe and warns clients publicly. The depression doesn't come, markets recover, He is wrong, loudly and expensively. He nearly loses the firm, has to let people go, and borrows money just to keep the lights on. Dalio's origin story is not genius always wins, it's failure forces process. He concludes that conviction is dangerous unless it's constantly tested, and that memory is unreliable unless it's written down. So he starts writing principles. He turns decisions into something like engineering documentation. If I believe X, what evidence would disprove it? What signals should I watch? What mistakes does my mind repeat under pressure? How do I design around them? Over time, those written rules become culture, and culture becomes something close to a machine. Dalio's macro worldview is rooted into the plumbing of economies: credit creation and contraction, interest rates, inflation, capital flows, and central bank reaction functions. He becomes especially focused on debt cycles. There is the short-term cycle, where expansions lead to tightening, recessions arrive, and policy eases again. Then there is the longer cycle, where leverage builds across decades, rates trend downward, and eventually the system hits constraints. That is too high, rates can't fall much further, and standard tools lose some punch. This is why macro funds obsess over yield curves. The yield curve is not just a chart, it's a compressed story about growth, inflation, and policy. Short-term rates reflect central bank decisions and near-term expectations. Long-term rates reflect longer-run expectations plus risk premiums. When curves invert, it can signal policy is tight relative to growth. When they steepen, it can signal easing conditions or rising inflation expectations. Macro traders live inside these shapes because they map directly onto real financing conditions for governments, corporations, and households. Dalio wants to formalize that intuition, identify the regime, understand the constraints, and position accordingly. Bridgewater becomes famous for all weather, often linked to the idea of risky parity. The goal is not to predict perfectly, but to build a portfolio that can survive multiple environments: rising growth, rising inflation, falling inflation. The technical insight is that diversification is not achieved by owning many assets. It's achieved by balancing the drivers of risk. If one asset class is far more volatile, it dominates the portfolio's behavior no matter how diversified you claim to be. Risk parity aims to allocate so different assets contribute more balanced risk, which often means using leverage on lower volatility assets like bonds. That sounds reckless if you equate leverage with gambling. In this framework, leverage is a tool for making the structure coherent. But it also introduces its own dangers: sensitivity to shocks, liquidity squeezes, and correlations that spike when stress hits. That's why risk control and scenario thinking become central, not optional. Bridgewater's other flagship approach, pure alpha, is the active macro engine. Here the firms make bets across countries and markets: bonds, currencies, equity indices, commodities, and spreads. These are often relative bets because prices already embed expectations. It's not enough to think growth will slow. You have to think it will slow more than the market expects, or sooner, or in a way that forces policy to shift. So the work becomes a blend of data, models, and debate, tied to strict risk management. The firm studies credit growth, inflation dynamics, policy constraints, politics, external balances, and the way shocks transmit across borders. The goal is not poetry. The goal is repeatability. Be right more often than wrong, and survive the periods when you're early. Bridgewater's culture becomes as famous as its strategies. Dalio promotes radical transparency. Meetings are recorded. Employees rate each other. Junior staff are encouraged to challenge senior staff, including Dalio himself, if they think an argument is wrong. The intent is clear. Reduce blind spots, reduce deference, and treat disagreement as a mechanism for better decisions. To some, it feels like an unusually honest laboratory where truth is extracted through friction. To others, it feels intrusive and exhausting. But the larger point is that Dalio is trying to solve a problem every high-stakes organization faces. How do you avoid being trapped inside one person's ego, especially when that person is the founder? Whether you admire or dislike this method, it is an attempt to build an organization that can think at scale. Soros and Dalio are very different men. Soros is explicitly political and philosophical, comfortable at the intersection of markets and ideology. Dalio presents himself as a student of systems and cycles, describing constraints like an engineer describing a bridge. But their shared role is extraordinary. They run funds that treat countries as tradable instruments, placing wagers on currencies, rates, and macro regimes. Those wagers can spill into real life through exchange rates, borrowing costs, and financial conditions. They are not omnipotent, and they are rarely alone, but they concentrate influence because they can express an opinion with size, and size can force a conversation. There's also a quieter, more useful lesson under the glamour. Both men are obsessed with learning. Soros builds a philosophy that expects error and feeds on feedback. Dalio builds a machine designed to capture mistakes and turn them into improved rules. Underneath, both are trying to do the same thing: adapt faster than the world changes. If you zoom out across decades, you can see the evolution of macro trading itself. The early era is human-shaped. A few smart people reading political signals, watching rates, making bold calls. Over time, the industry moves towards more structure. Soros formalizes reflexivity. Dalio turns principles into models. And then the next wave takes the idea further. Funds emerge where the core asset is not worldwide but code, where alpha is treated as signal extraction, and where speed and data matter as much as interpretation. In that world, a currency is not a national drama. It's a time series with statistical properties. And that is where our story goes next. Soros and Dalio show us macro powered by human interpretation, narratives about policy and psychology, and a constant effort to learn from mistakes. The next chapter starts from a different premise: that markets contain countless small inefficiencies, repeated and fleeting, and that with enough data, the right models, and fast enough execution, you can harvest those inefficiencies again and again like an industrial process. Some of the most famous names in that world wrap themselves in secrecy so thick it becomes part of their edge. Others build engineering organizations at enormous scale with research teams, infrastructure teams, and trading systems designed to operate without hesitation. They are quants. They live in signals, error bars, and latency. Next time, we step into that world.